Today, folks, I want to explain to you why I think we're on the last legs of this stock market crash. We are in this reactionary environment where news has been driving the stock market so far down into these suppressed levels where it's starting to become a little more irrational than I think compared to the market we're currently sitting in. We're going to listen to Cathie Wood, who made some remarks on the inflationary market that really fall in line with what I've been thinking and why in the next 3 to 6 months I think we're going to come out of this bear market, which is why this window of opportunity that exists for you if you are frugal, if you're able to come up with cash, start buying your favorite assets. Obviously, always be buying your favorite assets, but this is the bottom basement I think we're about to see in prices. We're also going to be taking a look at stocks that have absolutely crushed it this year, and I think that opportunity is long coming past at this point, and next year these stocks are actually going to underperform the market. And then I'm going to talk about stocks that are just getting slaughtered right now that are probably becoming pretty good buying opportunities. But first and foremost, the reactionary environment here, folks, all has to do with inflation. After several days of the rising performance, U.S. stocks are headed lower, most attributed to the decline to the August inflation rate, which was higher than expected. The annual rate was 8.3% for August, down slightly from the reading of 8.5% in July, but higher than the expected 8.1% moreover. So taking a look at the inflationary data here, guys, a lot of other things are kind of lagging to the rest of the inflationary market, I'm going to say, because obviously we know energy, a lot of the commodities market is absolutely crashing right now, and commodities is what controls the price of aluminum cans to your building supplies with housing and all this stuff. Yet we know that everything is crashing right now. I mean, across the entire spectrum, when we take a look outside of a few things like lithium here, because I can't get over the demand for lithium, but when you take a look at copper, guys, huge building material here, crashed miserably. Steel crashed miserably. Lumber is crashing miserably. We all know that the end of inflation is on the horizon here if it hasn't already come to an end. The problem is it lags to the market. And what we're also going to see is the overglut of product of people not buying luxury goods anymore is going to start getting discounted. We're seeing it with things like Rolexes, cars, luxury cars. Anything in the luxury market is just getting absolutely just completely catastrophed in pricing right now. So why are we still seeing the market react so dramatically to the inflationary data here? Because it's not like it missed by that much of a percentage point. Now, obviously, you could argue how people are feeling at home by this, and oh my God, the interest rates going up and mortgage prices are going to crush people. And yeah, if you got a variable rate mortgage in the last 6 months, you're probably one of those people getting slaughtered. But as housing corrects, the interest raising environment doesn't change a person buying a house, because the price of the house comes down. That person, even though the interest rate is higher, is still pretty much paying the exact same monthly payment if they're getting into the housing market today. So when you kind of look at it from that perspective, it shouldn't nearly be as a reactionary environment as the markets are reacting to this news, in my opinion. I think it's over exaggerated. And I just want to listen to this little Cathie Wood quote, because I think it kind of falls in line with this statement.
Thank you, Maria. Great to be here. Thank you for inviting me.
So you tweeted about Fed policy earlier in the week. You said, quote, "I would not be surprised to see a significant policy pivot in the next 3 to 6 months." What did you make of Powell's speech yesterday? And tell us what that pivot might look like in the coming 3 to 6 months.
Yes, well, he repeated what he said in Jackson Hole, essentially. They're focused only on prices. Now, they have a dual mandate, employment and prices. Frankly, I'm happier that they're focused on more of a price rule, so that's good. But I think the reason for the pivot is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range, while copper has broken down, oil is breaking down, lumber has crashed, iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. And the way I describe what's going on right now, I was in my early days in my career in the early 80s when Volcker was taking a sledgehammer to inflation because it was embedded in the system after 15 years of profligate spending, Vietnam War, Great Society, and then going off the gold exchange standard. A sledgehammer, that's what he needed. That is what I believe Chairman Powell thinks he needs. And we just don't think that's true because we see so much deflation. And then one more thing. We also see a massive inventory overhang around the world. You've got Europe in recession, China in recession effectively. And here in the United States, retailers are bulging with inventories, which will have to be cleared with discounts. So we think we're going to see some major downside surprises in inflation during the next 3 to 6 months.
Now, this isn't necessarily the best of things because obviously as prices come down across the board, it's going to do better for the money in your pocket, but that doesn't do better for company earnings because they're going to see margins crunch. They're going to have a harder time moving products at these much higher prices. And right now, obviously, as inflation cools off, companies are trying to hold on to these price hikes. That's why we're seeing such a lagging indicator to all this inflationary data, not bringing it down as fast as obviously commodities are crashing. Companies are going to hold on and try and make the margins they can well they can. But at the same notion, guys, what does this mean for companies? Because obviously it's going to lead to even worse earnings reports. But if there's one thing I've learned about the stock market is it does not trade off earnings reports, right? Like clearly valuations have nothing to do with market trading fundamentals. Again, we see a little bit of a change in the inflationary data and boom, the stock market tanks. But arguably the S&P 500 is still relatively overvalued. It is down 18% year to date. But when we take a look at the historical PE levels, we're trading around 19 right now, which is still above average, but much more at par with the median being around 15 to 16. And even though it's trading at a higher value, I think it kind of deserves to be for the same reasons I've mentioned in the past, that we are in this technological revolution where value is being added to the market at an exponential rate, whether it's automation, you're going to McDonald's using one of those type pads. I mean, we're going to start seeing automation take over many, I think, of restaurant jobs. Robots can just do so much more than we can at a much better value. And all of that equates to better value for companies. So I think we deserve to be trading at a higher multiple. I've always said that because we're in some kind of a weird exponential growth phase where every sector of the market is shifting. This is like Kathy Wood's entire thesis to the market, whether it's crypto, financials, healthcare, genomics, self-driving, and this big shift to the auto market, which I'm going to say one more time, guys. In your lifetime, how often do you think every sector is going to do a massive technological jump? I mean, we went from internal combustions to electric vehicles. Do you think we're going to go through that again? I mean, this is a once-in-a-lifetime opportunity, in my humble opinion here, folks. But obviously, as interest rates continue to rise, we're seeing strength in the US dollar. This is something nobody really talks about, which I find very interesting because as inflation cools, the dollar becomes more valuable. Your purchasing power is starting to come back pretty aggressively. I mean, take a look at the 5-day chart. It's crazy how the US dollar responds so aggressively to those interest rate hikes, right? So it's kind of a catch-22. It's good, it's bad, but I think we're literally seeing the last leg of this bear market territory. Come back to me by Christmas here, guys, and I don't think we're going to be seeing the same kind of negativity that we continue to see. I think we're going to see the opposite of, oh, things are getting cheaper, oh, the value of money is getting better, and we're going to stop seeing headlines like this where Ray Dalio says interest rates to squash inflation could tank stock prices by 20%. I mean, realistically, we've already seen that tank the stock market by 20%. So that story and that rhetoric is eventually going to slowly fade out, in my humble opinion. So what has been doing exceptionally well through all of this? Well, obviously, it's been everything related to utilities. I'm actually kind of blown away by how recession-proof utilities have been, but it's also something a little bit sketchy because the valuations, as people run to find the investments that are working, become overvalued. Inevitably, they're going to shift those dollars out of these kind of investments and go back into the tech investments because tech is still continuing to grow much better than a utility is that's trading something like Southern Company here at a PE of 27, which is very, very high. I mean, take a look at Duke Energy. This thing's up 3.8%. Southern Company's up 14%. Enbridge, a lot of these energy and oil stocks, guys. I mean, Enbridge is still up 11% on the Canadian side of the border here. Hydro One, which is another Canadian utility, just crushing it this year, up 6.55%. And most people think, well, it being up 6% is not crushing it. But when you take a look at the long chart, and unlike Apple, unlike Microsoft, unlike all these tech companies, these things are actually at their all-time highs. And again, these values for these companies are getting pretty excessive here, right? So I think when we start seeing the turnaround in people's interest in these safe haven kind of investments is also when we might start seeing the shift in the general markets back into tech. Because just taking a look today specifically, guys, it is wild. I mean, look at Google. Google's at $1.04 today, guys. If there's ever a buying opportunity in tech, Google's a screaming buy. You take a look at Ethereum here, guys. The crypto Ethereum just went through its merge into proof proof of stake, which a lot of people predicted was going to be a hype trading market around that news cycle, and the sell-off sure enough did come. And I mean, proof of stake, that merge couldn't have happened at a worse time, right? Following in tandem with the Fed news. So I mean, you can see Ethereum's down 5% here, guys. Bitcoin's down about 1%. But again, we're not seeing like these wicked new lows. That's another thing that I wanted to point out here as well. Even though we're getting a lot of this negativity, it's not like we're seeing it into like wicked crazy new lows in the general markets and for most of the major stocks when you're talking about things like Apple, Microsoft. However, that doesn't mean things aren't getting to new lows, because I mean, we just saw Adobe post earnings, and I gotta say, I am blown away that Adobe's down 45%. Could you imagine a company like this is down 53% in a year, and now we're back down to literally the pandemic level prices? Literally, like the lows that we hit in March of 2020 is now back to where Adobe is sitting. And a lot of people are freaking out by this because, again, we're still in this kind of sell-off news. And I read through Adobe's earnings. And again, guys, they were not that bad. They're doing more investments, so they're seeing a bit of an EPS hit, but revenues were great. I mean, just take a look at this. The revenues across the board here, guys. Total revenues for the 9-month end we'll take into consideration went from 11.6 billion to 13 billion. These growth rates continue to fall in line with things are cooling off, but it isn't this detrimental period that the news media just keeps shoveling down our throat. I mean, we saw earnings come out of Google and all these big tech giants quarter over quarter still come in better than I would have anticipated in such a slowing down market. This comes back to go look at GDP from 2019 into 2020, guys. If you just kind of go back anywhere 3 to 5 years ago, we're in a much better place. So the question we have to ask ourselves is then basically, you know, if we're still sitting in a much better place than we were 2 or 3 years ago, you know, where is the true bottom of the market? Because you also have to take into account that if inflation is impacting the general markets here, guys, and there's an 8% inflation rate, then you have to knock 8% off the total returns this year for the S&P 500, which means we're realistically down something obviously a lot more, like 25 to 30%, which means we could, again, be seeing the bottoms, the actual bottoms in the stock market here. And I think I'm going to continue to state that, and we'll see what happens over the next 3 to 6 months. But at this point, I want to pass the question off to you guys, right? Like, this is just a period, a really intriguing period in the market, and it's a period where you, and especially if you are a newer investor, you may think you've missed the past bull runs, but I'm promising you there's going to be a lot more bull runs in the future. But as these prices come down, you can't get scared of people telling you, oh, it's going to drop 50% from here. We're nowhere near the bottoms yet. There's so much fear mongering that you kind of have to fight through it and continue to just cost average and buy these stocks at these levels and just wait. I know patience is the hardest thing in the market, but I promise you come back in the next 3-4 years and this conversation will be completely mute. But on this point, I want to pass the question off to you. I'd love to know what you guys think in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.